On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Hi, team. Hope you're all well. It's April now, so I thought that's a timely opportunity for me to do a bit of a recap of the March 2024 quarter and also share a few thoughts about what we should be keeping an eye on over the coming 3 months. To begin with, this year has started very strongly for investors. Returns in the March quarter were much better than many people would have predicted at the beginning of the year. World shares rose 7.8%, and just like last year, just like 2023, it was the United States and the Japanese markets that led the charge. The S&P 500 in the US gained 10.2% for the quarter. That saw it surpass its previous high, which came about 2 years ago in early 2022, and it finished the month of March and the March quarter almost 30% above where it fell to in October last year. And it was a remarkable run. At one point, the S&P 500 had risen for 16 out of the past 18 weeks, and that was the first time we saw that happen since 1971. So it has been a very strong period. Optimism over developments in AI, artificial intelligence, were again a major driver of the gains. We saw Nvidia, the star performer in recent times, surge another 82.5% during the March quarter. So that stock has had a fantastic run, and many other stocks that are also exposed to AI and that broader technology theme have also performed very, very well. In Japan, we saw the Nikkei 225 index rally a staggering 20.6%. That's just in the 3 months to the end of March, up almost 21%. And that's the strongest quarter we've seen from the Japanese market since 2009. Other international markets were up more modestly, but they were still up. Emerging markets, the UK, Australia, Europe, all of those markets were up. Not as much as the US, not as much as Japan, but they were still up. And a weaker New Zealand dollar boosted the returns from all of those offshore markets to New Zealand investors even further. We saw the currency fall below 60 cents against the US dollar for the first time since November last year. So that's down about 5%. And it also fell against the British pound, the euro, and the Australian dollar. New Zealand assets did lag again. That's something we saw last year, for the last few years, to be honest, and that's been the case in 2024 so far too. So in this first quarter of this year, the NZX 50 share market index here in New Zealand rose 2.8%, which is actually better than it did all of last year. It was up 2.6% in all of 2023. So we've already had a better year and we're only 3 months in. But that does pale in comparison to some of those returns we've seen from international markets. Corporate bonds here in New Zealand also posted a small gain. Interest rates are actually up slightly since the beginning of the year, wholesale interest rates, that is. The 5-year swap rate started the year just shy of 4.1%, and now it's sitting at about 4.4%. So it's increased by about 30 basis points, about 1/3%. But because investors are actually collecting some very good income streams from their bond portfolios, there's at least a buffer there now to offset any adverse price movement. So that's what you've seen this year. Even though prices for bonds, when you sort of mark their valuation to current levels, you've seen a bit of a decline, but people have collected a fairly good income stream in those first 3 months of the year, and that has actually offset those price movements. That's a really important concept to understand, because that's something we haven't seen for a few years. 2 years ago, 3 years ago, with the very, very low interest rates, the income that you were getting from your bonds was so pitiful that if you saw any price movements go against you, you were in negative territory in terms of your total return. But now you're at least getting a 5 or a 6 or even higher in terms of your yield, your annual income stream. At least you are seeing that return, and that gives you a bit of breathing room in case you see price movements go in the wrong direction. But anyway, just like 2023, investors that were well diversified, that had a global mindset, have been handsomely rewarded. So as long as you had your assets all around the world, you weren't just hunkering down in New Zealand shares, New Zealand bonds, New Zealand houses, New Zealand listed property. If you had a more global approach and you had some US shares, some European shares, some Australian shares, some Japanese shares, you will have done absolutely fine, more than fine. In fact, you will have actually made some very good money and some very lucrative returns through this first quarter of the year. In terms of the economic story, it's been one of further resilience. We've seen a lot of indicators point to solid activity, and they have supported the case for a soft landing. The US economy has continued to impress. We've seen a raft of good indicators coming out of the US, whether it's the labour market, whether it's the manufacturing sector. Just a few days ago, we saw some good news on that front. So the US has been very, very resilient, very, very strong. Europe definitely hasn't been as strong as the US, but it's been a lot better than expected. And even in China, you're starting to see a bit more stability emerge. We had some PMIs over the weekend, purchasing managers indices, and they rebounded to a 10-month high for the month of March, the highest we've seen since I think it was May last year. In contrast, the New Zealand economy has continued to disappoint. That is the way the indicators have played out here over the last 3 months. We got some new GDP figures during the March quarter, some new gross domestic product figures, and they showed that the economy has contracted in 4 out of the past 5 quarters. And that's come despite very strong population growth. So there has been a bit of a mixed bag when you look out there across the world. You look at places like the US that are very strong, other places like China that have been much weaker, and obviously New Zealand has been struggling a little bit too. On the inflation front, it's been a case of 2 steps forward, 1 step back. You've definitely seen progress from where we were at 6 months ago or a year ago. Price pressures have eased in all regions. In the US and Europe, annual inflation's now sitting below 3%, so it's getting back towards where central banks want it to be. Here in New Zealand, 4.7%, that was the latest reading that we got, moving in the right direction, but a little slower than we've seen elsewhere in terms of the speed and the pace with which it's coming down. In Australia, similar story. But we are seeing evidence that this last mile of inflation might be more difficult to beat. The battle is not over. And that's been the case in the United States, where even though you've seen inflation come down from the highs from a couple of years ago, so you're either in the mid to high twos or the low threes, depending on which measure you look at, it's sort of petered out in terms of coming down any further. It's got a little bit stuck. So PCE inflation sort of stuck in those mid to high twos, and the regular CPI, the regular consumer price index in the United States, is sort of stuck in the low threes, and we're not seeing it come down any further. So that is something that we need to be mindful of. The easy gains might be behind us, and from here, there is an element of stubbornness in some of those inflation pressures out there. Central banks, these have been in focus over the last few months, and I think that will continue. We did see a couple of milestones during the March quarter in both directions. We saw the SNB, the Swiss National Bank, become the first of the big central banks to cut interest rates this cycle. They cut interest rates in March, and also in March, it might have even been the same week actually, the Bank of Japan hiked interest rates for the first time since 2007. The Bank of Japan has been very much out of step with everyone else. They have had negative interest rates right the way through since I think 2016 might have been. And they haven't moved them. Everyone else has increased interest rates, got to the top of the hill, and now we're talking about when do we see the cuts. But the BOJ has just left them negative, and now we're starting to see the first increases. Central banks will remain a focal point in the months ahead, certainly this quarter, the June quarter, and then beyond. Interest rate cuts are on the horizon just about everywhere, apart from Japan, but the timing is difficult to predict. I think if I had to put money on it, I would say the European Central Bank could be next after the SNB. June is shaping up as an opportune time for the European Central Bank to cut interest rates, and I think there's a good chance that they are the next one to move. The US Federal Reserve probably won't be far behind, same with the Bank of England, but I'm just not sure if we'll see that in the second quarter. There are some people that think June is the time for the Fed to cut, but I could see that becoming a third quarter story. The Fed next meets in May, then it's got a meeting in June, and then it's got a meeting in July. And June has been touted by many as the time of the first rate cut, and that might happen. But I'm just a little bit wary of whether the Fed will potentially wait a little bit longer. So wait and see. European Central Bank, it looks a little bit more likely though. Here in New Zealand, the economy over the next 3 months will keep struggling. I think we'll have another tough quarter or two. The Reserve Bank hasn't hiked the official cash rate here in New Zealand since May last year, so they've been on hold for almost 12 months. But at the same time, many households are still facing more headwinds, and I think those headwinds will grow, not subside. And the reason for that is more than half of all of our collective mortgages are set to reprice at some point over the next year. And the average rate that people are paying is still about 1% below current rates. I think the last data set we got from the Reserve Bank was for the end of February, and the average mortgage rate that people were paying was 5.9%. And if you look at the 1 year, the 18-month, the 2 year mortgage rate, they're all still sitting around that 7% level, give or take. And at 5.9, there's still about 1% that needs to be added to a lot of people's mortgages. So because of that, I still think there is a little bit of pain to come. Now, our share market doesn't mirror the economy particularly well. So even though you've got that tough backdrop, I don't think that necessarily means bad news for our listed companies. Remember that the NZX is dominated by stable, mature businesses in sectors like electricity, infrastructure, healthcare, real estate, those sorts of industries. And weaker economic activity does increase the chances of OCR cuts coming sooner. Remember, the Reserve Bank is still talking 2025, but not many of us believe them. Financial markets see the first OCR cut coming in August. And if that happens, that should benefit a lot of the companies in those industries. The Reserve Bank meets next week, actually. We're not going to get a cut then, that's for sure. And they might still play their cards very close to their chest. But after next week, they've got meetings in May, and then July, and then in August. So over the course of those 4 meetings, they could change their tune because we have seen a weaker economy and a lot of indicators that do point to things slowing more quickly than many expected. So watch this space there as well. World share prices are at a record high. I said that near the beginning, but New Zealand share prices actually ended the month of March 19.1% below their early 2021 peak. And that was more than 3 years ago. Remember, the NZX 50 index is a gross index, and that includes dividend returns. So if you look at one of the indices that the NZX puts together that is capital only, share prices only, you'll see that share prices are still almost 20% below their highs, which is quite a different situation to what you're seeing in Australia or Japan or Europe or the US, where in recent months, all of those markets have hit new highs. So we definitely are still lagging. One of the reasons for that is that rising interest rates haven't been at all kind to our market in recent years. All of those sectors that I mentioned before, infrastructure, electricity, the utilities companies, real estate, those types of industries and sectors and parts of the share market are more sensitive than most to changes in interest rates. So they tend to be restricted or less loved by investors when interest rates are high or rising, and they tend to be more in favor and perform better when interest rates are stable or going down. So there could be a bit of a shift that is on the horizon. Now, don't forget that in the decade leading up to 2020, New Zealand shares outpaced their international counterparts on 7 out of 10 occasions. So I know New Zealand shares are out of favour at the moment. That was the case last year. That was the case the year before that. So these days, everyone is doing a lot better with their international shares. But cast your mind back to the 10 years leading up to 2020, it was very much a different story. 7 out of 10 of those years, New Zealand shares were actually the place to be. So, maybe things will be a little bit closer over the next few years. Another really important test for financial markets could come as early as next week, and that will be with the US corporate reporting season. And it'll kick off, I think, next Thursday or Friday, usually with the financial heavyweights. So you'll have Wells Fargo, you'll have JP Morgan, you'll have BlackRock that will all report results next Friday overnight. And then you'll get a plethora of companies reporting results over the next few weeks after that. And this will be really interesting because market expectations are still quite optimistic when it comes to how earnings will look this quarter and this year. If you look at the 2024 calendar year, the US market is expected to deliver revenue growth in aggregate. This is the S&P 500 I'm talking about. Aggregate revenue growth of about 5% and aggregate earnings growth of about 11%, which is pretty good when you've got an economy that should be starting to slow down a little bit under the weight of the highest interest rates we've seen in 20 odd years. Now, what that means is that the bar for avoiding disappointment is quite a bit higher because expectations are relatively bullish, relatively optimistic, and you've got share prices across many sectors, not all, but many sectors that are close to or at record highs. So I think if we're going to see a sell-off in the months ahead, and when you're investing in shares, sell-offs are common. Markets don't just go up and up in a straight line. It's a bumpy ride, and when you've had a good performance like we have, you know that a sell-off or a correction of some magnitude is just around the corner. That's normal. That's just part of investing. Don't be afraid of it. Just accept that is the way things work. But if you're going to see that in the months ahead, I think earnings disappointment is potentially a catalyst for what might drive that. It could be weaker earnings, it could be good earnings but softer guidance, negative comments or just less optimistic comments about the future. But looking beyond the next 3 months and into next year, I think what we can be more certain of is that inflation should keep trending lower and that interest rates will almost certainly be below where they are today. So if you have that economic resilience remain, if economic activity holds up, it's okay if it slows, but as long as it doesn't completely fall off a cliff, and none of the signs are pointing to that at the moment, then you've still got quite a good environment for growth assets and certainly for fixed income, because interest rates coming down is typically a positive for fixed income returns. So I don't think the backdrop is too bad. It's just that prices have risen quite strongly and you've had some quite good returns. So, to be honest, a bit of weakness wouldn't be a bad thing because it might offer an attractive entry point for investors and another opportunity to put some fresh capital to work. So, hopefully, that's useful. The good news is that you will have had a very lucrative first quarter. Returns should have been very healthy, and you should be feeling good about where your portfolio is at. The next 3 months, I think we should prepare ourselves for a bit more of a bumpy ride as things progress, but at the same time, don't be afraid to use any periods of weakness as an opportunity. If you're a long-term investor, that's exactly how you should be thinking. You should be looking forward to any periods of volatility because that's when you do your best buying. All right, thanks team. We'll talk again soon.